ladies and gentlemen. Welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, we'll have a look at a very interesting fact that actually happened during the 2016 period. Before that, however, I would like to apologize to our attendees today, as my voice could be a little bit different from any other time we get together. I've been on a sick leave for about 4 days, so I'm still recovering. However, that's not going to stop me from doing my job. And today's session, we're going to talk about fundamental plus technical market assessment, which of course can be used not only for intraday trading, but for long-term investments, also for short period scalping techniques. All of that, however, depends on the type of the technical system that you are going to use. One which could be not only one, of course, so that wasn't the appropriate word, but those that I would have considered appropriate for myself, of course, and you would consider that on your own as well, should also be considered as technical systems that can be used by traders that, of course, can incorporate it into the fundamental assessment that they are going to do. However, I have also pulled out a lot of information here, not only from the major events that happened along the way during our trading experience for the year of 2016, but also something that will, of course, reflect in the future throughout 2017, of course. Therefore, the final two sessions, we will have a look at appropriate systems that are more conservative, should I put it this way, which could be very well used with a type of an accuracy and success ratio over 80% from my experience. And that we will talk on our final sessions. That would be next week. Before that, however, we will have a look at today's session, the examples that I'm going to give you, and the simple system that we're going to use. We're going to plant about 3 moving averages only, so we can track the basic trend, or should I say the short, mid, and long-term trend. Also, speaking of short, mid, and long, that would depend on the particular chart that we're looking at, or the time frame that we're looking at. So right now I've switched to a daily chart because it's very easy for a daily chart to spot mid and long-term trends. Now, if we go down a notch to 4, 1, or 30 minutes, we will see that all of that would also be relevant, but with just a few differences. That speaking of, let's say, 30-minute charts, the 200 exponential, which you see in front of you, would have the meaning of a daily chart, for example. You see? And furthermore, for the 50 exponential that we're also going to use, but of course I didn't choose the exponential setting, so I'm going to have to change that to an exponential. There you go. You can see how it actually changed from simple to an exponential. So that's the difference. You know, it's a bit more sensitive to fluctuations. Therefore, I'm favoring the exponential moving averages rather than the simple ones. So the other one, let me have another moving average. That's the 21, one of my favorites. But then I'm going to take color of white. It's much better visible. Okay. Now we can see that on a daily chart, those moving averages that are mostly relevant to our current setup is pretty much the 50 exponential, the yellow one. You can see that it's supportive, and in a lot of cases the price action is resisting from it, and the 200 exponential. The 21 could also be used in this chart. However, that's a minor support or resistance level. Therefore, it could be used in an established trend. So if the price starts reversing, the 21 exponential is very easily broken, rather than 50 and 200 are a bit more different than that. However, if we switch to a 30-minute chart, we can see how the things are slightly changing. You can see the 21 is acting much more often. So basically, we have a reaction from it a bit more often. Therefore, it could be used much more often to trade and to spot directions or entry positions like this one. But if the market starts reversing, of course, the 200 and the 50 would start acting as major levels. So if the price action breaks to the upside right now, as we are looking at it, that would mean that a new direction could be expected if it's confirmed. But this is a very simple explanation of how moving averages are working. What I'm actually trying to implement with all this is that I'm trying to say that, you know, the most simple strategy for following the trend, you know, is good enough if it's aligned with the fundamentals. So you don't need a very huge, a very important, should I say, or a very secure technical system. Excuse me. I'm still having a dry cough from my illness for a few days. So I have to mute my microphone for a few seconds so I don't blow out your ears. Okay, using a very strong technical system that relies only on technical analysis, that can bring you profits for the future, like in the long term, of course. That's something that we've been focusing on. However, the fact that we're focusing on technicals, and sometimes when technicals fail, that will be on the means of any fundamental event, of course. And why is that? Let me explain it a little bit, a little bit more in details. It's very easy, let's say easy or possible, to find out or decipher or anticipate certain movement of the market based on patterns or when particular currency pair or commodity, or let's say instrument as we usually say it, crosses, for example, a major moving average, or gives you a signal on the chart that tells you a direction, a target, and a stop level. But it cannot be usually predicted for the future whether it's going to be possible, a positive or a negative effect from any fundamental data before the numbers are out. Instead, all of that is technical is mainly focusing on the past, because there is already data that can be calculated, evaluated, and of course incorporated into trading. And this is your technical indicators. Like, for example, with a combination you make a very powerful strategy. However, the anticipation or the careful assessment of any fundamental data, ladies and gentlemen, before the release could give you enormous advantage due to the fact that you can position yourself earlier with the appropriate technical system, of course, whether it's supporting your expectation of the fundamental release. Now let's take a few examples before I actually start telling you what fundamental and technical assessment altogether means. We've had some turmoils this year. I'm just going to briefly mention them, okay? And later on we're going to get back into those and track on the chart and see what happened. Of course, we're not going to go so far back into the beginning of the year where we saw the reaction of the last year's December rate hike. Rather than that, we're going to see today's, this year's reaction of the market, which was absolutely similar, like twins. It was pretty much the same. The market did exactly the same thing. No change at all. So the most recent one, okay, what we had was the attack in Germany. Okay, markets in Europe are still lower. We're looking at the euro right now, by the way. We're looking at a 30-minute chart. This is from, okay, it was here somewhere, if I'm not mistaken. So this was the market, about 100 pips when that happened. And during that time, our technicals, the most basic system, is showing us still downside. So here, of course, we cannot expect that there is going to be a terrorist attack in Germany, okay, or a tsunami in Japan, or a hurricane somewhere else in the world. Those are the things we cannot control. So we have to stick with what we know, because everyday life teaches that we have to use what we have in our pocket to make our life easier. It's like doing an equation, okay? You have to use everything that it's given to you in order to equalize it. Otherwise, even if you use one dot or one number, single number, you will fail, and you're going to be going around in a limbo, failing again and again to equalize the whole thing. But what we actually had, that it was expected, there were actually a lot of things. One thing, the Federal Reserve and interest rates, Brexit, the presidential election in US, the Italian referendum. Okay, those are 1, 2, 3, 4 individual things which were actually tied at the end of the year, basically in the last few months. So, okay, without the Brexit, of course, that was a long time ago, but what I'm trying to say is that all of these things were expected. These are economic events that we can anticipate, and of course do our homework and decide whether we're going to be going up for the euro versus the dollar or down for the euro versus the dollar. It's just an example. So the Forex market, as we know it, is the most liquid of financial markets anywhere. Fundamental and technical market assessment is the key, which is based on a decision on fundamental analysis that focuses on economic data, events, sentiments, in order to derive a bias that will, of course, provide with a decision or with an expectation for those traders that would like to stay prepared and consider their next move according to their technical analysis. What does that mean? It means that opening the, on a daily basis, opening the economic calendar, tomorrow, for example, US GDP, it is expected to be higher than previous. Well, who wouldn't? We had the interest rate hike obviously, for a second time in a decade. How about that? Everyone is expecting that the GDP would be a good number, or at least unchanged, let's say. If it's unchanged, of course, we could expect some weakness from the dollar, but it could remain on the steady path, near its 14-year highs. Now, that means that even if the dollar remains at these levels, even if it's actually coming off of these levels for the past 1 week, the euro is still declining. And this is mostly on the events happening in Europe. Not only the attack in Germany, but also something that happened close to Europe. That was the assassination in Turkey, as I suppose some of you have heard. The Russian ambassador was shot on the back, pretty much the same time the attack in Germany happened. So you can see those two events were probably coordinated attacks that actually are systematically prompting Europe to crash, and basically the market, the economies, the major countries, or those that are trying to be members of this union, like Turkey, for example. My aim to all this is that besides the fact that the dollar is coming off those highs, the euro is still under pressure, but not only from those geopolitical events that are happening, but also from the decisions that are made within a single country, and of course the decisions that are taken by the ruling members of the European Union. All of these events can be predicted, or let's say anticipated, should any person or trader decides to do a little bit of homework. Now, if we're focusing for a single country and its currency, let's say we're focusing on Sweden, for example. We have the Swedish kroner there, or Denmark, for example. We have the Danish kroner there. Also, these two countries are in the European Union, but of course, you can also trade these two currencies versus the euro, okay, which is the shared currency within the Union. And if you make that connection, everything that's happening in the European Union is affecting also Denmark and Sweden, because they are in the European Union, but they're not affecting their local currencies as much as it's affected the euro itself. Okay, if something bad happens in the European Union, not specifically in those two countries, Scandinavian, it's going to weaken the euro more than it's going to weaken the Danish kroner and the Swedish kroner. Based on that fact, we can buy one of those kroners versus the euro and benefit from all this. This is how fundamental trading is based. Because we're looking for some kind of correlation based on countries, not technically correlated by curves, Those two things are absolutely different. Speaking of putting together technical and fundamental analysis, some traders often ask themselves if technical analysis, for example, can be used as an effective substitute for any fundamental analysis. Although, of course, there is no definite answer whether technical analysis can be used as a whole substitution for fundamental analysis. There is a little doubt that combining the strengths of both strategies can be, of course, a tremendous success to a trader that masters the whole thing. And of course, the market direction would be in your reach. Speaking of putting the two things together, we of course are going to focus on volumes and trends. So when a technical analysis is made to match fundamental events that are about to happen, but we're still anticipating their conclusion, of course, a trader is researching the particular instrument that he's trading, which means it is good to know that what other traders are thinking about this particular instrument when it comes to fundamentals aligned with technicals. I hope you're following me, and if you're not, and if there is something that you're not understanding, please let me know. Just drop me a question, and I will just you know, go a few steps back and repeat what I said, so we can be on the safe side, because I need you all to understand what I'm trying to say. Therefore, I'm going to repeat that. When we're using technical analysis to trade any instrument along with fundamentals, we're going to use as a base volume and trends, which means when a trader or an investor, of course, because fundamentals are mostly for investors, is when a trader wants to trade, let's say, the euro dollar. Okay, it's on the screen. When you guys are going to trade the euro dollar, for example, you have to research the euro and the dollar and both economies, right? And also it is very good to know what other people are thinking about it. It's not always good to share your opinion first, of course, otherwise the other person might not be absolutely aware what he's about to say. So of course you will always have to somehow appreciate and at some point trust, or let's say not trust, but you could take an advice or an opinion from a person of your choosing. That's why you have to choose from the person that you have to ask about certain events. That's not always an easy task, to be absolutely honest with you, because there are a lot of people that will pretty much speculate with the information that you have, so they might not be aware of about anything that what you're asking them, but they're eager to know what you think about it. And you might be actually on the point, you might be right about it, but they do not want to share their own opinion, or they do not want to come out as the fool that doesn't know what is happening on the market. So you know, those two things are pretty much close, and they're walking hand in hand. But this is from a psychological standpoint. So me personally, I don't mind sharing an opinion or you know, expressing a thought, whether it's wrong or not. That wouldn't be a bad thing. Any of it. Now, the first thing could reinforce my belief. That's one, which would be a good thing, because it is going to actually raise your own stamina, your own energy, you know, and therefore your focus will be much bigger. The other thing, of course, could you know, could prove that your research was not good enough. Therefore, you have to dig deeper. So there is a benefit in the good and the bad as well. You cannot deny it. That's the way it is. One of the most popular methods, however, is we're at it to anticipate market sentiment, is to take a look at recent traded volume. Speaking of recent traded volume, let's have a look at the indicator here. Okay, I thought it was somewhere here. Show volumes. There it is. Okay, that's one of the way. There are also volume indicators that are customized, of course. This is day-to-day volume, as you can see, or the period that it is. But as you can see, the highest levels of the volume are actually the lowest level of this trend. Okay? All of this is the first sign of a trend build. As long as the volume stays above zero, you have a trend that is established. But of course, if it makes a curve like this one, okay, this is a peak, that's a top. And those peaks are exactly the places where we're actually going to start looking for an entry, if you're a technical trader, of course. You have the first plunge, you have the crossovers of the moving averages. I'm simply speaking from an example here, okay, if you're using as simple as this strategy. And then your entry is here, and your exit is over here. That's about 200 pips, or even over it. This is from technical standpoint, okay? Given the fact that here, exactly, we had a major event, and that was the Federal Reserve's decision, that also points towards the downward direction on the euro versus the dollar. Why? We already know why. Because the dollar is strengthening simply because of higher inflation, because of the Federal Reserve raising the overnight rates with 25 basis points, making it 0.75 right now. So all of that, we have a technical system that is showing us downward direction. We have a fundamental expectation that it's going to go down, so we start positioning ourselves, okay? We are supported by our technicals. We're mostly technical traders, but we're not overlooking those fundamentals. That's why we're connecting them. So we need to understand those. We are going to enter here with a conservative position because we're looking for a trend, for a market that is trending, because the dollar is going to keep strengthening from now on. Therefore, during the following days, we're going to see a lot of downside movement. However, that particular move happened on the wake of the release of the interest rate decision. The fact, however, that the information travels differently in the world, okay, why I'm saying this, well, given the time zones, ladies and gentlemen, this is something that you always have to keep in mind, especially of releases like these. I've actually kept repeating this when we are talking about fundamentals and stuff like that. I always talk about the time zones. Now, if you are not in the city where the announcement has been made and you're watching TV, for example, even then you will have a delay of a few seconds, basically because it's a cable TV. And this is another thing. So the time zone is not particularly 1 hour. It could be a few seconds or even a minute. So you cannot make your clock 8 hours in 1 minute. It doesn't really make sense, does it? Because in the other one, it's going to be 1 hour and 30 seconds, for example. That also doesn't make any sense. But what makes sense is the fact that the information travels differently, and that's a fact. If you make a small experiment, just take a TV, one TV next to another. One of it is with a cable TV, or let's say an optical TV, you know, optic wiring. I don't know if you know what that is. I'm sure you do. And the other one with an antenna. The one that will receive the news first is the one with the antenna, and that's obvious. Now, enough electronics. We're going to talk about fundamentals here. The connection I made here is that in my time zone, for example, in the wake of the release, I might be here somewhere, okay? So my entry could be already here, and I would be getting about, that's 70 pips more than someone that is going to get the news somewhere within this candlestick here. Okay, this is 30 minutes. You have no idea where we're going to go here. Even if I go down to 1 minute, it's pretty much going to be the same, but we're going to have to scroll pretty much a lot. Anyways, you get the point. That's something that you should not regret about. What you actually have to focus on is the fact that you have a reliable system. A very simple technical system, which the one in the screen is just for an example. those which are actually going to be used along with the fundamentals, and how are we going to align all of this. We're going to talk about it on our last two sessions, where we have part 1 and part 2. And I'm saying for those that keep coming in on the webinar, as I can see they're aligning on every few minutes. So there is a part 1 and part 2. It's going to be technical trading systems, of course, along with fundamentals, for the first quarter of 2017. And that's pretty much going to be based on the fundamentals from 2016, along with the technical systems that I've prepared, plus what we're expecting in 2017 and how we're going to start positioning ourselves. Back to the topic. We have a very simple trading system, technical, which is based on trend and volume. We're entering after or prior our expectations of the Federal Reserve's rate hike, and we're gaining market momentum, which is extending this currency pair with another 200 pips to the downside. Before, the volume ended by a gap. It's like a small gap here, as you can see. You know, it's rarely that you can see gaps like this one. Okay, here. When you see a gap like this one, the first bar is a high one with a large volume. The next one is a gap, which means the volume actually crushed. You know, it decreased very rapidly, which means it starts a reversal. And the volume that you see is to the upside. It's still a volume. It doesn't matter which direction it is. The volume doesn't tell us which way the market goes. It just tells us how much volume on the market is. And of course, the market keeps coming down. After that, we see a gap, and another decrease, and another gap. And we can see that the market starts in a sideways direction, correction, another downside, which is irrelevant because it's already a sideways direction, and we're not focusing on that. It's trends and volume. So the volume indicators are very popular. There are a lot of these. Why I'm telling that, and I'm not giving you any specific ones because we're still not going to go there. I'm going to say that another time because I can see the questions that are coming in. Many of you guys are eager to find out what are the indicators. I'm not going to tell you one more time. I will tell you that next Wednesday. First, let me cover this topic. On Friday, we're going to talk about the post factors of the Federal Reserve interest rate hike, because it was one of the biggest events for the 2016, and basically because we were expecting it every month, and it actually happened in December. So that's why I'm saying it's very important to discuss it, and not only, but based on the fact that Fed Chair Janet Yellen claimed that there will be at least 3 more Federal Reserve hikes next year, which would be a major historic event. As I said, the popularity among traders from the volume indicators can be, of course, evaluated on the specific strength and speed of the indicator itself. Also, traders should watch the volume to increase as a trend gains the momentum. So this is the thing that I actually explained to you when we were following this small trend here. Okay, the volume gains as the trend progresses, and it starts decreasing when the trend ends. This is not very difficult to understand, but it's still something that I had to mention. Therefore, my next chapter here today would be about the short-term market movements. Now, one thing, and I had a question here, so I'm going to hurry up and answer it before I forget to do that. There is one of our attendees that was asking why are we using only this section of the chart and we're not using any other. Well, I can tell you one thing, that the specific technical system or should I say not specific at all. The example of the technical system that I'm using, there is nothing to show on the back of the chart. We're only tracking historical events, but if I have to move throughout the whole year, I'm pretty sure that 1 hour or 2 hours are not going to be enough, because we're going to have to scroll a lot back. What I'm actually trying to do right now, before we actually get to next week's two parts of technical systems where we're going to be scrolling back and see those events now done, then it's relevant because we have about 4 hours to deal with this, and in 2 parts. So that would be more relevant. My aim, my goal today is to show you how we can combine both analysis to make a powerful system, and that's why my next chapter is to track the short period moves, and that is why I'm not shifting the chart, dear trader, because this is what we do. We're tracking short period trades. We're on a 30-minute chart. We have a good trend, a good volume example here for our topic, and therefore we can focus on just one small part of the market move where we have all the specific rules of today's topic. Now, this is why I'm not shifting the chart. So many fundamental traders or investors are actually focusing on a long-term odds or events or trends, let's say, that they are actually trying still, when looking at daily and weekly charts, to obtain a proper price of to buy an instrument or to sell it in order to profit from the difference of it. However, if you're from the fundamental side, it's always good to use technical analysis, or at least to look at the short time frames to find a better buy point, or let's say a bottom, okay? Bottom like this one, or a peak like this one, for example. Conditions like any technical trader would look for to make his move to profit from the difference. However, a fundamental trader would focus, let's say, on daily chart. Sorry about that. On a daily chart where you would be waiting for the curve, for example, because you're going to be probably looking for a line chart, a curve that is going to be start dropping, then it will start raising up, okay, and then come to a point from where it's going to start dropping again. And this is a type of a swing trading or a wave trading, where you can enter here and close it here on about 600 pips of profit. That's for about 17 days. But focusing on a fundamental analysis and looking at the chart on a long-term basis, for example, you're waiting the whole year for the interest rate hike, and it doesn't happen, but it's still there, the expectation, the funds rate is priced in on, let's say, 60 to 40%. Next month is 70 to 40. The other month is 60 to 40 again, or 50-50, for example, depending on the fundamentals. But you're still looking at the curve. The market is still downwards. That's just an example. I'm just using this trend. Therefore, you're going to be entering in on these fundamental expectations because of this interest rate hike. I'm taking it as an example because most of the people understand it as it's, how to say, it's already stuffed in their heads from everywhere. And my goal is to make you understand how the whole thing works with the most understandable thing in the news right now. Therefore, your entry would be here, for example, and then you have that expectation. Nothing happens, the market is retracing. Then it comes the next expectation, the market is going down and down again. The next expectation, nothing happens. The next one, Nothing happens, and that's 3-4 times. Then the market gets tired, okay? Tired of stupid announcements, of lies, or let's say somebody tells you that something's going to happen and it's delaying it for the next few months, but it doesn't happen. But once it comes the end of the year, for example, and the thing starts happening, you know, there is no other way. It's going to be now or next year, which means now or never. So everything starts to price in for that event. And finally, of course, it's going to break through the lowest low. It's not confirmed though, but it's there, it's possible. We can still go to a parity, which is somewhere down here. You can see it's not that far away on a weekly chart. My idea of saying why fundamentals are not to be ignored, or if you're a fundamental trader, technicals are not to be ignored, is the fact that you can benefit from both by bringing them together. Fundamental traders can find a better entry when they're looking at the charts and technical indicators, which are telling them, let's say we have a crossover here, we have a downward direction, the volume is big, so I can start selling. Now I can start looking again on the daily charts and wait for the event to happen, for example. Not wait for the event to happen and look at the daily chart and look for a good price. No, that's not going to happen, because you cannot spot a good entry price, for example, on a pattern that happens once a week. Well, when that pattern happens, it can confirm so far away that it's actually going to make a small move to your direction and start reversing. I've seen it happen. Not a very good thing, by the way. But of course, those are things that professional fundamental traders are already doing it. I'm just saying that it's properly done. If it's properly done, as I mentioned, it could save you a lot of trouble and can make you a better profits, let's say. If you're a good fundamental trader, but you don't look at technicals, it will give you better entry. More specifically, when something breaks through, like this one, through a moving average with great importance, like the 200 or the 50, it gives you an advantage because the market is going to start building through. But if you're looking at a daily chart, for example, now that 200 exponential is far away, the 50 is far away. You have the 21, but you're here. So what are you going to do here? Nothing. You don't have a confirmation or anything. You actually have a reversal signal that it's about to confirm. You know, this could be a morning star on the bottom of a downtrend. So all of these things are not wrong, but you cannot overlook even the little things over here when you can't enter on a good price, and of course catch bigger movement. Now let's see. There is also another thing which would be the last thing for today. Something that we spoke earlier. Ask about what other people think. It's the same thing about the market. Okay, there are a lot of different people, or a lot of different opinions about one and the same instrument. Sometimes there's a very large portion of these people with one and the same opinion, but they could be wrong. They could push the market to a certain direction because they're large in number, but the actual market is actually going to push them out by getting its own direction, which means the first market reaction to a worse than expected event, let me put it this way, could be to the upside. Let's say we have tomorrow GDP and it's worse than expected, for example, and the euro starts climbing by the first market reaction, but it actually hits a resistance level like the 200, and then starts reversing to the downside. All of these people that actually decided and have placed long positions on the euro dollar could actually suffer losses based on the fact that they're not looking on the other side of the economic calendar. That's just an example again. If the further right side of the GDP numbers are, let's say, it shows larger, a smaller number than today, or the same number as today, but the expectations were bigger, that's not necessarily bad. Now, if you have 3.3 previous GDP growth, the expected is 3.5, but today you have 3.3, which is still worse than expected, but it's the same as previous. Again, that's not necessarily bad. That means stable economy. That means that a bunch of economists that are gathered somewhere making decisions and collecting opinions from surveys and so on and so forth are putting a number which is expected. That means that the market is expecting. No, that means the particular surveyors are expecting this kind of number. That is not necessarily bad if the number comes lower than expected, because the economy is still stable, because it's the same as previous. Now, if it comes worse than expected, worse than expected and worse than previous, and we already had the rate hike, that would be very, very bad for the dollar. That would be actually, that's going to be a very strong leg up to the euro. Now, that's a different story. But what I'm saying, when the sometimes the bunch of people, the crowd is wrong, is the fact that the initial market reaction is what a normal or a professional trader waits out until it cools off, until all the numbers are digested, until everybody or the small fishes, starts dying out, and the market takes direction as it's supposed to do. Well, the things that I mentioned earlier, and I'm going to finish with this, about the terrorist attack in Germany, also the referendum in Italy. Also, this caused the resignation of the Prime Minister Matteo Renzi. That was also bad for the euro. The Brexit, the vote actually to leave the European Union saw a new Prime Minister, Theresa May, and she replaced David Cameron. So you see, a simple vote could change the direction of a currency. We saw the British pound slumped with just a few minutes. Also, the election of Donald Trump, the initial market reaction was that if Trump was elected, then all of this would change the whole outcome of the Federal Reserve, the interest rate hikes and the dollar direction. It saw actually gold rising more than it actually did for the whole year, like in percent. Okay, the largest one-day rally when that happened. But when Donald Trump actually went out to speak to the public, the announcement he made was that he's actually going to push for higher inflation, for everything else than the market actually expected him to say. All of that sprung the dollar up to a 12-year high, and that happened for one day. That was an amazing day, by the way. It was amazing. Gold fell with the same amount of percentage that it actually did, that went up the previous day. So you see, there were a lot of disappointed traders, but there were a lot of happy traders. Those happy traders were because they were lining up with the technicals while they're waiting for the fundamentals. So they're ready to cut their losses short if that's necessary. However, let's say if you were short on gold long before the election results, okay, if Clinton was the elected president, let's say, that wouldn't change too many things on a political level because she would have continued the Obama administration. However, with Donald Trump, there were a lot of speculations that there was going to be a lot of uncertainty, and based on that, investors sought some security going into metals or safe havens like gold, like yen. All of this made the dollar slump, and of course, eventually, when we saw that the things are not exactly as they were expected, everything came back to normal. I wouldn't say everything went very good, but it went to normal because that's what it had to happen, because that was the actually expected thing for a very long time. That's why we had the interest rate hikes. That's why we had the bond buying program for so long to prop up market conditions and economy. So all I'm saying that putting fundamentals and technicals in work together properly could be a very powerful tool, and for a very long time, because technical strategies could work, but for a very limited time. That's why we keep developing for you guys, absolutely free, if you wish to use them, systems that could, of course, deliver profits on short or long-term basis by our view. Of course, this is what we think about the market conditions. You are not bound to use them. It's for educational purposes only. So the whole thing about the technical analysis is because day after day, month after month, year after year, market conditions are changing, fundamentals are shifting. All of this causes the need for adjustments to our technical systems. Therefore, we need new ones every day, or if we have very good ones, so we at least have to shift something or change a few numbers here and there to make them work properly. Therefore, this would be the last thing for today's topic. Thank you very much for joining us. Of course, I'm going to see you on Friday. We're going to talk about the post effect of the Federal Reserve's interest rate hike. There are a lot of interesting things that we're going to talk about then. This is this Friday, same time, of course. And next week, we're going to go straight into technical and fundamental systems all together to see in two separate parts what we're all talking about for the whole month. Well, thank you very much for joining us. It was a good 1 hour talking. And of course, if you have any questions, drop us an email at webinar@gdmfx.com, or just visit our website, gdmfx.com, or drop us a message on the chat and we will get back to you right away. That's all for today. See you next time. Bye-bye.